Good
All right.
afternoon. Happy Monday. What is going on? Albert, how are you doing, sir?
I am doing well. Um, it's Monday, beautiful weather outside. It's
I know.
just I had a really restful weekend, and I'm glad we've got Andre on again. I've been
Yeah.
blowing him off for the past 3 weeks. We've had
No
getting ready for
problem.
tax time, and I've been blowing him off for the past 3 weeks. I'm like, okay, well, I'll have
This
to
is
meet with
this is
later.
the time of year when some investors they just go and hide under their investment properties. The ones
Yeah.
with pier and beam that you can crawl under really easily, that's where we go during this time of
Oh
year.
man, I've got a funny story about that when I was a kid, but that's for another time.
You got stuck under a house or what?
No, I fell asleep underneath a parent beam house, and I had happened to. I was really little back then, and you could climb underneath, and I fell asleep against one of the piers, and my brothers and my sister, who were responsible for me while my parents were at work, could not find me. So my parents get home, and it's after 6, and it's starting to get dark, and they cannot find me. They called the Galveston Police Department, and they sent a detective to our house. And eventually I just kind of crawled out from underneath I woke up, crawled out from underneath the house, and it's like, what's going on? And it was a funny story. Anyway, that's the
How
short
you were
story.
how old?
I was probably between 5 and 7 years old, maybe.
Wow. Okay.
Yeah,
Well, hey, good job being okay.
but I made it.
Yeah. So we are wrapping up our investor tax strategy deep dive. We've been covering what are we've been talking about? Tax favored white real estate is a tax favored asset class, bookkeeping, separation, treating real estate investing like a business. We had Lynn Sparks on week 2. Andre is um, back. We begged him to come back. He at first he said, "No, you guys are losers. We don't want to talk to you anymore." And then
Yeah.
we paid him a lot of money. No, I'm just kidding. No, he's Andre with Atlas Tax Advisor. He's been very generous with his time this month. Andre, how are you doing, sir?
I'm doing great. Thank you guys for having me again. Glad to
Dude,
help you.
hey, the last 2 episodes that you were on, I felt like was for me personally, I had some breakthroughs, and I'm ready to stick it to the government, man, because there are ways that we can really take advantage of some of these these tax strategies that you're sharing with, and it's like gold. Why why do you think for entrepreneurs, and maybe I'm just speaking for myself, but I know I'm not because I work with a lot of business owners. Why do you think this subject is such a such a brick wall for people?
I think it's very detailed. There's a lot of nuance, and for some reason, people just don't like to focus on a lot of that minutia stuff. It just seems boring. It seems unimportant. It seems something that they want to delegate to somebody else to manage for them. So they take no time to educate themselves or retain that information. It is hard to explain. It's really important to know that even if you
Hmm.
delegate all of it or part of it, you need to still orchestrate your whole setup. You need to know where things are and how they should be moving. So it's incredibly difficult, time consuming, and its mental capacity that it takes is quite high. And people just that's what the block is, I think. So you just
Yeah,
need to realize the value of this planning, the value of knowing this. And you don't need to know all of it. Just know big pieces and just don't be scared to kind of venture into that.
yeah,
And just reach out for questions. There's a ton of resources now with YouTubes and AI, and there's really no shortage of like resources. It's more of a just take the interest,
yeah,
own your business, like you said, real like treat it as a true business. And so, you wouldn't abandon your typical normal business somewhere and just let somebody do it and you just not even looking into the books, right? So real estate is the same way. You have to analyze it, you have to know it, you have to plan for it, and you'll be more successful. So, but you can overcome that. Just take
yeah,
initiative, interest, and don't be scared. It's an area that seems complicated, but it's repetitive. There's some major elections you can make, and there's a lot of little things that you can kind of ignore. So it's something you can definitely do with some effort.
We were working on getting some of our tax stuff together yesterday, catching up, staying organized. It's an ongoing process, and I have different types of 1099s for different things. I I was curious how many different types of 1099s there are. I counted. Albert, do you have a guess of how many different types of 1099s there are?
20?
I counted. Do you know the answer, Andrei?
I really don't. Like, I don't remember, but I know there are a lot. But in practical terms, there's really not a ton that people will face. Most people, I mean, of course, 1099 non-employee compensation, NEC, that would be the
Yeah,
most common. But then the miscellaneous one for any kind of rent you pay, those are going to be the two
yeah.
landlords will see. But then you can have interest, one for dividends. So there's really four or five that you'll see all the time, and there's a few obscure ones that'll come
There's
out.
there's a lot of
Uh,
obscure ones. Albert, you were off by one. There, I counted 21 that I looked up.
Yeah, that was my guess.
And that's what's listed on a 1096, which I didn't even know what that was until just yesterday, what a 1096 is. What's a
yeah, it's like
1096?
it's like a summary return that shows the totals and what was submitted. So it's kind of encompasses all of the filings. So there's a lot of reports, there's a lot of filings, there's a lot of this coding that's kind of done behind the scenes. IRS knows a lot about us, that's
Yeah,
for sure.
I know. I propose that we rename these forms, that we give them fun names, like name them after like spirit animals or, cartoon characters or something, We'll remember those forms a
I
lot
know.
easier. So,
How
Andre,
about we?
again,
How about I've got a suggestion here on that note. How about we give them a pain threshold? We set a new pain threshold from 0 to 100, and depending on how painful it is to fill that form out or to get it from someone, right?
Mhm.
You assign a pain threshold number. I'm always thinking about how much time is this going to take, and
Mhm.
how overwhelmed am I going to feel, and how many times am I going to text my CPA? So. It's pretty much a pain threshold.
Oh yeah.
I don't know.
Hey.
They're all kind of up there. So, Andre, for our new viewers, guests who may not have tuned into the last episode, tell us a little bit about your business again. Just give us a quick blurb and what you do and what sets you apart from other tax specialists.
Absolutely. My name is Andrey Tetuyev. I am a CPA. I am an advisor first. That's kind of what differentiates me. I work with business owners to educate them, to try to eliminate some things that they need to know, give them options, and alert them to those options. So I am definitely more so on that end than just filing and moving on. So that's what makes me different. My background is a little bit different. I used to be a lender, worked with commercial banking for 17 years. So also I'm kind of more aware of that whole part of financing and strategizing and how the bank will see your books and your projects. So that background really helps me deal with real estate, deal with business, and just kind of see how these numbers connect in different areas, not just for the IRS purposes, but any other users of financial data.
Yeah.
Again, like you're saying, buyers of businesses, lenders, any partners. So that's just kind of like how my attitude is coming into doing tax. It's more of a kind of all around encompassing project, not
Hmm.
just give me forms that I'll slap on this return and move on. So that's what makes it different.
Awesome.
Nice.
Thank you so much. We're so glad. Let's dig into it. Albert, you wanna state the disclaimer?
Yes, so just please, as you're watching this, maybe you're watching it live or as a recording, this is really for educational purposes only. If you'd like professional advice, I'd advise you to reach out to Andre directly and then get that agreement in place, and then he can advise you professionally. But otherwise, this is for educational purposes only, so don't take anything that we're saying here as legal or tax advice.
We are mere entertainers here, providing some. So if last year you bought a rental and your CPA, if he or she didn't ask about depreciation strategy, cost segregation, passive loss limitations, you're probably overpaying. You probably need to fire your CPA. Would you agree?
Yes.
So we're going to be talking about tax strategy for investors. These are the strategies that are actually going to move the needle. This is one of the benefits of investing in real estate it's a lot of the tax advantages. So um, yeah, so let's dig into it. Dig into it. So context. We left a lot of things hanging last week. We probably could have kept going on for hours and hours and hours. So we're going to try to revisit some of the topics that we left open. Albert, was there one or two things that you felt like, hey, we need to really come back to this? We were talking about
Well, I know
LLCs.
we hit a lot last week. We talked about personal and LLCs, right? Putting things in your personal name and putting things in your LLCs. How simple that is, but then if you want to scale, right, is having things in your LLC, and really kind of keeping the separation of your expenses and things like that. We talked about that. We talked a little bit about Series LLC, what it is and what it isn't, and right how banks and lenders can be a little averse to lending to Series LLCs. What we talked about as well were self-directed accounts, like self-directed IRAs and things like that. We touched on that, and I think we may want to talk about that a little bit more
Yeah.
today, and kind of like the cost benefits and kind of some of the things to watch out for, when if you're going to use a self-directed account. And I know one thing that we kind of trailed off on and probably didn't really get it much to talk about was community property, especially for the people that are listening or watching in Texas, and how that's a pretty big deal here in Texas and community property. So that was a quick recap of kind of what we talked about and some of the things that we kind of left hanging last week. So
So I think we can take a vote. My if I have to take a vote, I'm going to hit on the self-directed and then the community
Hmm.
property number two.
Great.
What what did you have?
I think that's good topics to kind of spend a little time for sure.
Okay,
yeah.
perfect. So start us off. So what exactly is a self-directed IRA? Are there other than the IRA, are there any other type of self-directed accounts, or is that specifically one thing that we're referring to when we had that conversation?
No, you can do self-directed different accounts. You can do HSA could be self-directed, could be 401k, could be an IRA. There's any kind of like investment account like that could be, allowed to do that. And what it does really just allows you to invest in more than just a handful of securities. A lot of brokers allow you to invest in an IRA. And so it's complicated and it kind of works a little bit against Wall Street. So a lot of brokers kind of guide you towards stocks and bonds, and that's the primary vehicle of investment if you think about IRAs. But there are plenty of custodians that would say, you know what, if you know what you're doing and you feel like you can beat stock returns with real estate, with lending, whatever you're
Hmm.
into, where you have expertise, we allow you to do it within your IRA. There's some rules for that, like how to carry that out and what to do because it is a trust account. And so there's clear rules of not allowing you to benefit yourself personally from that account. If you do, that's okay, but it's a distribution. Just like
Right.
if you would take money from your IRA and you would go buy a car or whatever, same thing with this kind of concept. When you have an activity that's other than stocks in your IRA, like real estate or business, so if you end up violating some of these rules of prohibited transaction, it'll be considered a distribution. And penalty will apply, and you'll have to pay the amount you consider distributed as taxable income. So there's some consequences of mismanaging some of these formalities. So that's why it becomes like, something of a unique focus you need to dedicate to self-directed account. But it's a great vehicle for anybody who knows what they're doing in real estate and that could enhance their return possibly using that kind of structure.
So these self-directed accounts are the primary purpose. Are people mainly using these for like long-term savings or retirement purposes? Or are
Yeah,
there other strategies behind that?
it's a retirement account. So just like any normal retirement account, it's long term, ideally, so you can appreciate all the assets and use them when you need them in retirement.
So benefit, obviously, same with any IRA is that the tax earned
Mm.
in those accounts are going to be completely and 100% deferred, correct?
Yes, it could be tax deferred, or if it's a Roth 401k, Roth IRA, tax could be gone. So if you invested in it and you're producing a lot of returns, that money will grow and you can get it tax free when you retire. So it's the Roth IRA could be an amazing strategy if it's self-directed. If you can compound your returns and let that money grow tax free, it's an amazing vehicle. So I would definitely alert people to that strategy for some higher return projects.
So with Roth IRAs, there's annual limits how much you can put in that. Is that the same case here, or is
Yes, and it'll follow the same rules for contribution limits, phase outs, all of that is definitely a part of planning. If you have high income, you might be phased out of Roth accounts, but there are strategies to convert traditional funds into Roth, or you can proceed with something like a Roth 401k, Roth STEP IRA. There's other ways to place money into Roth kind of accounts. And so that's a little bit more maybe advanced, but that's definitely something on the table. And people with great cash flow and some planning, you can definitely put a lot of money into a Roth type of account, let it grow tax free for many years to come. And so I see that my clients do that, that physicians and some others have cash flow that allows them to pay tax now, convert something to Roth, or just place it through like a Roth 401k. So it's really popular.
I,
hey, go ahead.
Allison, I think I know where you were going with that question, and because it got me thinking as soon as you asked it, with the contribution limits that there are, which Andre just touched on. Let's say, for instance, you have a portfolio of rental properties now in this Roth IRA, and they're generating income. That cash flow that gets back into that just is more of like an appreciation vehicle and not a contribution. It doesn't count towards your contribution, right?
Correct. Yes, that's whatever
Okay.
returns you're generating, that's new money if you're placing into that IRA, whether it's self-directed or the normal one, it would be subject to limit testing. Yes. But whatever
Oh, okay.
returns, the rent's coming back into a self-directed IRA, it's just returns like a stock would, like a
Like a
dividend.
stock, like yeah, like a stock dividend or something like that. Okay.
Yeah.
Yeah, cool.
That stays
That's great.
inside the account. So can so is this an account that I have to start fresh? Am I able to transfer the funds from like a Roth IRA or 401k or 403b? Is if I transfer those funds from an existing account into the self-directed, is there any tax implications? Are there any penalties there? And can I start buying real estate with that money right away?
Yes, the answer is it's pretty simple. Like you would do a normal transfer from Fidelity to Schwab or whatever. So you just money, as long as it's not coming to you personally, it's not a distribution. It's just a transfer between custodians. And self-directed works the same way. If you find a custodian that can manage these funds and allow you to invest in other projects other than stocks, you would just open an account with them. It'll be a self-directed IRA account and you will roll over the funds that you have with another custodian over to that account. And from
Hmm.
there, you tell your custodian where you invest the money. And there's strategies for how to handle that. In my case, I have an LLC that is owned by my self-directed IRA. So I just have a very simple looking structure. If I go to face the world and do certain transactions in my
Right.
IRA, it looks like an LLC, just happens to be disregarded entity owned by my retirement account. And so in that, I can act as a manager on behalf of my LLC owned by IRA. And so I can execute documents outside of my custodian's involvement. If you have just a straight up ownership of if you buy a rental property and it's owned directly by your IRA, then your custodian will have to execute all the documents on your behalf because it's your IRA, it's not you individually who's involved.
Okay.
So I've kind of instilled another layer of convenience for me where I don't need to call my custodian and say, hey, you need to sign this lease agreement, or I can just sign it on
Oh,
behalf of the manager of it.
so
Mm.
how are the custodians making money?
They make money different ways. One of them is the self-directed accounts have an annual fee. Like what I pay is probably like I think it's 500 now. It used to be 350. So, they manage enough of these accounts. They have fees for that. And then depending of some other fees for, some accommodation transactions for wiring. So and some of them also manage assets. So if you invest with certain things through them, then they could be also generating fees on that transactional side. So it's more, kind of volume and customer base is what generates fees for them.
So the custodian is signing everything on behalf of the account?
Yes, if it is a directly owned IRA type of property, then yes, like you cannot sign on behalf of an IRA because you're just you're the owner of the IRA, but the property could be owned by your retirement account itself. So you need the custodian to execute documents. And that becomes really cumbersome. It becomes you need to send documents for review and then get to sign it. Some I've seen some custodians that they kind of say, well, just sign and you'll be okay. But that's violating some rules as well. So it's a lot of formality in these structures. But there's again this disregarded entity LLC structure works really well with real estate projects
Yeah.
like I just mentioned because it just removes some of that burden.
Well, it sounds like
Yeah.
a really great way for a lot of people to get in the game, the real estate game, especially people that have been investing in their retirement accounts for all these years. And maybe they're at retirement age, maybe they have retired and they have a pretty lucrative account on their hands. They can actually transfer those funds over to a self-directed IRA and
Mhm.
use that money that's still in that account to invest. Now, I want to know, I'm going to have more questions about the custodian, but before I do, um, I want to ask you more about kind of the logistics of what that looks like for somebody who's maybe older and they're either at retirement age or they're already taking draws out. Are there any, like anything prohibiting somebody from taking their normal draws in retirement age? I mean, you get taxed on those draws, right?
Mhm.
Personal
Yeah, if
draws.
it's a traditional IRA, again, if it's self-directed or just a normal one, anything you pull out of that, of course, will be added to your taxable income. So that's the consideration. If you're over the limit age, then there's no penalty,
Yeah.
and so you just take money as you normally would. So like for me, let's say in the shopping center that I own, if rents are coming in and I take a distribution, it's just it goes into my IRA. And from there I'll tell my custodian, like, hey, I need to take that money out. They basically wire that money into my personal account. So like it
Hmm.
would look just normally as it would if you sold the stock. That money goes into cash position into your IRA account, you take a distribution. So with these rental projects, it's the same way. Funds are accumulating, and then from there you can tell the custodian to withdraw some. So it's a good way for rental to create that cash flow
Yeah.
and pull it out. For me, math works really well, just given the nature of my center and the commercial rent that's coming in. It's perfect. Like I can take distributions basically for the partnership that I'm kind of invested in, and from there I just distribute money to myself. So like if I continue holding this asset for the next, until retirement age, that would be a nice little cash flow coming through my retirement.
Hmm.
Mhm.
And so that's a nice setup for that reason. So anybody older, the question is really, can these returns kind of exceed what the market can give you in a more passive way? So that's really
Right.
the big test. For a lender who knows how to lend money to proper project, or if you're a real estate operator that's really successful and knows how to measure these returns, and if you can exceed the average 7-8% in the market, then these accounts could really, really like accelerate your fund growth. Especially on the Roth side, but it could be tax free and it could be an amazing thing. But if you're just kind of mired in cash flow issues and you have vacancies, and so that could make this transactional kind of nature of account more complicated, but then the
Sure.
returns could be more as well. So for anybody who is like amazing at this game, and that's what hopefully that they're learning throughout their life, it could be an amazing thing toward the
Yeah.
end of their life.
And we go back to evaluating deals, and we're gonna next month our series is going to be about deal analysis. And we spoke a lot about this in the fall that cash flow is not the only return on your investment. The appreciation is pretty significant too. And when you're able to monitor and track that, just breaking even every month is not the end of the world if your asset is appreciating. So, I mean, it
Oh
should
yeah,
be,
for sure.
I would say from my experience as a real estate professional, yeah, you can beat 8% between cash flow and appreciation.
Oh, yeah.
Now, my next question, and Albert, stop me because I know you probably have some questions too. This is a topic I've been real curious about myself. The what can you break down the logistics of borrowing money inside of a self-directed IRA? Are there any how does that work? Because this is a brand new account. It doesn't have. It's not like your IRA has a credit score, right? So
Right.
how do they qualify those loans? Do they just base it on your personal credit, or is there more to it than just that?
It's definitely an interesting topic, and I see people make mistakes there all the time because as an IRA, you're not allowed to guarantee any debt. Because again, if you're putting your personal name on the loan that the IRA is involved in, it's a personal benefit. And as such, it'll be considered a prohibited transaction.
Yeah.
And so you'll bust through and it'll become a distribution. And I see people don't realize that they'll set up this self-directed account, go to a lender. Lender says, "Oh, great, I'll give you a 30-year loan. Just sign right here, and we'll get your wife to sign as well." And they think in their mind that IRA is borrowing and I'm just guaranteeing the loan, but you just disqualified yourself. So to
Mm-hmm.
answer that question you asked, yes, lenders who do this, they know that you cannot provide a personal guarantee. They know it's going to be prohibited, and they know there's no credit for the IRA. But they also know the IRA is a liquid account most of the time. It's somewhere that you put a lot of money and you have cash and you're buying a hard asset like a building. So they're comfortable with using the building as collateral, kind of ignoring the credit element of it.
Mm-hmm.
For that reason, they'll ask for probably 40% down payment, maybe 30% down payment. They will get a little bit more equity on the way into it, and they'll do a more personal guarantee, a real estate secured loan, with the IRA being the only borrower, and there's no guarantee. So there are lenders out there in the country that specialize in that,
Okay.
uh,
That was going to be
and
my
they're
next question.
and they're not necessarily in your backyard here, but they're national, lenders. There's some outfit in Tennessee that does a lot of them, and a couple of others. So they know the structure and they're comfortable with it, and they'll do it all day long. But the second thing comes in is again like kind of being mindful of no personal guarantee, finding the specific lender, not your credit union in the neighborhood, because they will do the loan, but they'll tie you into it without you
Yeah.
thinking through that.
They need to
And
have that
so
experience and background. They need to understand how that account works.
you have to do a no recourse loan on the personal side. Just only collateral is real estate. That's the only way to do it. And outside of that, if you end up with a loan, like we mentioned, UDFI is a type of tax that would apply to this account, which could alter your returns. That's one thing to be really mindful. Any tax that a retirement account, which is a trust, pays is a high level of tax. And so if you have to mix in, all of these additional taxes that could be applicable to your retirement account, that could really skew your numbers. And so
Hmm.
if you get financing in place for your IRA, that will be subject to this UDFI tax, which is like unrelated debt financing income. So if you're making money and you're profitable, the percentage of the profit as proportionate to the percentage of the loan you got on acquisition of the property will be taxable. So if you made $10,000 and you got 70% of the building finance, so 70% of 10,000 you'll pay a tax on as considered unrelated debt financing income. So that could become expensive. So that's why understanding leverage that you're using on the real estate transaction in IRA is key because that could really change your math quickly. Or trying to minimize or even eliminate lending and just try to use your retirement accounts as
Hmm.
just self-fund
Yeah.
and you will eliminate that tax.
Mm.
Are you seeing it used that way more than using leverage?
To be honest, I haven't seen too many uses of leverage. Most people that sophisticated enough to go to a self-directed route, they probably have a couple 100,000 sitting there. And they're comfortable buying maybe one property and kind of learning from there. But I've seen some financing done, but not many people think about this financing kind of cost.
Mm.
That's something I need to like really alert people to say, hey, if you're gonna borrow, if you can fully fund this deal from your retirement directly,
Hmm.
and you cannot just be like 10% short and you just like contribute your personal funds into it. You have to do it through a normal contribution channels. If you're short of funds in your IRA and you need to fix your building because like you need a new AC in your IRA, you need to contribute funds properly. And so, there are limits involved, how much you contribute every year. So you got to be careful planning not only the acquisition of real estate, but maintenance of it, paying taxes if you're
Yeah.
short and you have vacancies.
Wow.
So it's more of a kind of a setup initially, planning forward and trying to see, can I afford that? Or what I've seen people do, and in fact, what I did, you end up partnering your IRA with somebody else, and it could even be you. You would create a
Oh, that's
partnership.
interesting.
Right. So
Yeah.
it gets like really nuanced in that way, like how you can partner your deal with multiple IRAs. You can have your wife's IRA be a 10% owner of this rental. Your Roth IRA could be 20% owner. Your self-directed 401k could be 50% owner, and you individually could be 10% owner. is if you create a partnership like that, then each partner will get a K1, and if you're one of the partners is an IRA, that IRA will, will get a K1. But as a trust, if there's no UDFI tax, then you don't need to report anything. So it gets like really interesting how you can put these deals together and where cash flow comes from. The only problem I've seen is when people just try to come up with all the cash, let's say for acquisition of property, and they scrape all of the IRAs and they come up with enough money,
Hmm.
but then a year down the road, again, that AC goes out and they need to put 15,000 into the property and only one of the IRS has money, the other ones don't have it. And so like
Yeah.
you're kind of stuck. And so then if you need to make a contribution into that partnership, each IRA will have to contribute proportionately. If you don't, again, it's a self-benefit, it could be a problem. So it's quite complicated, like how this planning could be done. That's why all of the facts need to be there, liquidity and how much are you able to fund IRA every year. If you have higher limits, if you're a 401k, self-directed, it's much more flexible because the limits are higher and you can do a lot more with the 401k. Another caveat, 401k self-directed does not have this tax, this the tax that applies on active income. So, like the real benefit of having 401k is doing any kind of active project. So if you're flipping homes, normally if you do it in an IRA self-directed and you're a flipper like a real estate dealer,
Hmm.
then you would be subject to a tax on that income because it's considered non-passive rental, it's considered active income. But if you have a 401k involved, you will be exempt from that. 401k has that exception. It's kind of an interesting thing. So there's also some planning where you roll funds over. If you're a business owner and you can qualify for self-directed 401k, that could be much more beneficial in your strategy
Nice.
than just right. So it's a small nuance, but could make a huge difference in
Wow.
how you pay tax on that.
I
Yeah.
never would have known that about the partnership. And maybe we need to talk more about self-directed 401ks as opposed to self-directed IRAs, right?
In
Yeah.
in practical terms, it works out very similar. You just open a self-directed IRA. To have an IRA, the implication would be when you have a 401k, it implies you have a business and you need a business. If you have a 401k, if you have employees in the business, they have to be eligible for your 401k plan. So,
Hmm.
what I would say, if you have a self-directed 401k, you also need to consider how it will impact your employees. If you have employees, or if you will have employees. In my case, I don't have a self-directed 401k because they kind of want to kind of start down that path and then end up with having a bunch of employees later, and then I have to like make them share the same rules that I'm sharing with myself, for this plan. So, but I'm not actively running any business. I'm doing a passive rental, so it's not subject to unrelated kind of income, from a
Right.
business activity. So I'm not like worried about that, but somebody who would be flipping property, so doing something more like an active business running, that 401k could be critical. And so like again, planning that and how it'll impact your employee things is really,
Hmm.
really important.
Hmm. Yeah. I
Hmm.
think one of the things that comes up, right, is how after listening to you really get into detail on the self-directed Roth, this 401k. There's so many details, especially for a new person that might want to do this. You don't want to do it alone. And you don't want to
Absolutely.
depend on this custodian, right, who manages just the in and out of things and signing documents. Like they're not going to tell you, well, you have these UDFI taxes, and then you have to plan ahead for these maintenance and repairs and capital expenditures and things like that. How are you going to fund those through these self-directed IRAs because they both have limits on
Hmm.
contributions,
Oh yeah.
or all of them do. And so I think that's why it's so important to have someone as knowledgeable that's really on your team to kind of walk you through all of these things. Because there's so much nuance that like I didn't know. Like I'm just sitting here just like, oh yeah, this is all really good stuff. It's all pretty new to me.
This
So
is
It,
it's a great
it's a lot.
opportunity for a lot of people though, because I mean a lot of people that we know they've been working for decades and
hmm
they've been putting money away in their retirement accounts and they want to get
I
into real
know.
estate investing and this is a way, you can retire a little bit earlier or you can start putting that money to work tax deferred, right?
hmm
And look how many people don't even participate in stock markets. I know plenty of clients and plenty of my former bank clients who just they're just averse to stock market. They don't trust it. They just would argue with you that real estate is the only way to go. And so for those people, if they're comfortable, they're confident, and they're experienced, you know what they're doing, real estate could be amazing. If you do self-directed and it's like a commercial property, and you have a property manager handling this and you know how this works, you add value, you lease them up. That could be an amazing way to like create these assets and sell them. And there's no gain when you sell them. You don't have to worry about rolling it over to the next project. You don't have to worry about paying capital gains. You just worry about when you distribute money out of that account. So that's the only timing you're really worried about. So this IRA could really like make things simple, like when it comes to the timing of when you do these deals, like if I sell my shopping center, I don't care. Like I'm not worried about the deal. It'll sell, it'll go back into my IRA. From there, I can use that to become a lender. I can use that money to other property developers as a kind of a private lender. That could be another activity I could do. So it gives you like all these options, real estate related.
So
So it's quite amazing.
you bring up something that I thought about for just a second. So a lot of people are trying to do their 1031 exchange, and when they initiate that, they're on the clock. Is that something that we're avoiding, that kind of stress by keeping our
Yes.
money? Because that money can just sit there for there's no period of time, right? Like you could sell that property and let the money sit there, and you're not, subject to any penalties or anything. You can take your time with your next purchase, right?
Oh, yeah, because you're not trying. I mean, 1031 exchange is a gain deferral. You're taking the gain that you just created and you're applying it to the next project to kick the can down the road. With IRA, there's no gain. There's no tax on the gain, because it's
Mm.
as long as it stays within your IRA, the gain is just like gets added to your returns basically. And then it's up to you to withdraw money from there or just leave it there sitting. And you can just right away buy a new property and forget all this exchange business. So it really simplifies a lot of stuff for real estate people who again know what they're doing, and that could elevate their returns in a more simplified way. If you again learn the discipline and the not self-dealing, these kind of things, if you can kind of figure out how to get your personal hand out of these deals and really treat this project as truly owned by IRA, as though it's owned by another person, not you, then it could be quite flexible. And that's exactly why I did it. I wanted to go through the process and start creating returns. And my goal is to, sell that property when it's fully fixed and leased up and repaired and value added and everything, and then get that money back to me and look for another project kind of similar to this. And that was my motivation behind this whole project.
Man.
That's awesome. No, that I wasn't even expecting all that. That was great.
Yeah.
You continue to deliver, Andre. Good. That's good stuff
Yeah.
right there.
It's an amazing thing, honestly, because I'm really surprised people just don't know it's on the table. Like you start thinking, you talk to your kids, like open the Roth, open the traditional IRA, and I'm telling this to my children now, but you just automatically default position is, well, I'm gonna go buy Microsoft or like a ETF S&P 500. That's the
Yeah,
only thing people know. If you go to a 401k at work, that's the only option you'll get. They'll give you like a dozen different funds, pick the one that's a little bit more, like fitting your need, but then it's still very, very few choices. With self-directed, there's no limit to what you could do. If you're a little bit more sophisticated and you know kind of like what to look at in terms of project returns, you could do anything within that. And it just opens up this whole new world, of possibilities. And I see a lot of people do projects on the lending side. I see a lot of people with self-directed accounts become lenders. And again, it's very easy. They just use these funds and they can create, quite a return on private
yeah,
transactions. Short-term lending, they charge origination fee and interest and all kinds of things. So that could, definitely be market returns pretty great if you can underwrite these deals properly and not take too much risk.
that's great. That's awesome, man. We only got 5 minutes left, so
Oh wow.
we want
It's
to hit
that's
about community property a little bit. Albert, do you have any other questions about the now it's self-directed 401ks? Is
Yeah, yeah. No, this is all really good stuff, and I think the goal to with our show is to like we're planting seeds, right? And is creating more questions in our listeners and viewers' heads. Great. Now talk to your CPA about these things, right? Talk to
hmm
a professional about these things because this is what I heard on this podcast. Can you tell me a little bit more about it? Right, connect with Andre. He can get you set up and pointed in the right direction pretty quick. Now, I think this was really great information. We can jump right into the community property if we want to spend the last 5 minutes talking about that.
For sure. And there's a couple of things I want to hit on community property, but like I just want to follow up regarding if you go to your CPA and say, hey, I want to do this self-directed,
Mm.
don't be alarmed when they look at you funny because it's kind of a newer concept. A lot of
Mm.
CPAs don't like it, they don't trust it. It is a little bit of a specialty area. And a lot of people who even complete tax returns, they don't even know how to do the K1. At least that's what I've seen. They'll still put information on the individual owner of IRA and the K1 instead of the IRA itself. So there's a lot of areas where people are just not comfortable with the structure. So find
Hmm.
somebody, if you're truly interested in your tax team, they don't know that or not comfortable with it. Just there are providers out there who know more about it and just maybe like seek them out and you'll get resources you need. So that's kind of my message there. But on community property state, it's quite amazing in some ways, and it's something to be aware in some other ways. One of the big things in state like Texas, where community property state could be involving your decision making, is when you start filing returns separate from your husband or
Hmm.
wife. So it could be a reason to do that, and some people I know, some of my clients do that. Once you start going down this path of married filing separate returns in the community property state, you need to prorate and allocate all this income, and that could get kind of complicated with what happens because if you're reporting half of the income that your spouse is making is actually legally yours in Texas, unless you have some kind of prenup or some kind of agreement that will
Hmm.
bypass community property rules. And so you might find yourself in this position where you file joint return. It's simple because everything kind of returns together, and it's like nice and simple. Once you split them up, half of the income goes to you, half of it goes to spouse for every type of income. And so there's like some nuance and what if you have a property, it's a rental property that's held in, prior to community properties, so like prior to marriage, that asset could be considered capital gain that's outside of the
Right.
marriage. But the income, the rental income would be split 50-50. So there's some planning involved in that. Just be mindful again if you going down this road of separate returns. I have a couple of people that do it for a particular reason, and they just were like so puzzled by this, like how it's so complicated to now like work with your spouse to like split all the income properly and put it on your return properly, especially if you're like doing TurboTax and you're kind of used to this simple return, all of a sudden you can find yourself like bypassing this allocation. And it's kind of important for a state like here, in Texas. Another thing is just how community property simplifies reporting. I touched on it a little bit last time, where if you have an LLC owned by two people, by
Hmm.
default, the normal classification is a partnership. And partnership, again, involves a separate business tax return, which is expensive. So to bypass this partnership filing in community property state, husband and wife, the LLC could be treated as disregarded entities as long as they're together owners. It bypasses this partnership kind of default treatment, and you can just file it as a sole proprietorship on your Schedule E or Schedule C, whatever is relevant. And so that alone is kind of an interesting point of consideration. Will you file a partnership return like most LLCs with two people would, or do you just make this election to bypass that and just like put it on your individual return directly? So that simplifies. That's an option that people should be aware of.
So what do you normally recommend? Doing it as a partnership or as a separate or as like one owner?
I mean, I normally would recommend not to do a partnership. I mean, because if you have to do the partnership, it's complicated. It
Okay.
could get complicated, more expensive. So just for administrative ease, I would say don't get yourself, convoluted with a partnership. If you can qualify to get out of that filing, you can certainly put it on your Schedule E as long as both of you are involved. So that's just one of the things where I always like ask who owns this LLC. If I find out it's two people, I just tell people, hey, you should be
Different.
aware it's a partnership for tax purposes and it follows this partnership rules of how things should be reported. Then unless it's only your spouse involved, then in taxes it makes life much more simple. So I kind of that, just like if you can avoid filing a partnership return, I typically say, that's something to consider. But in my personal, issue. Like I still file a partnership return because like for me it's kind of simple. I just do it myself, because like when I go to a bank, I give them a partnership return. It's like more, it looks like a business. If you put it on Schedule E, and they get all confused
Hmm.
sometimes, like it's an LLC, but it's on Schedule E. So sometimes I have to explain more to lenders, like how my reporting and how my structure actually is. If I give them a partnership return, they're kind of happy and they leave me alone. That's more for practical reason is how I proceed with my rentals, as a partnership. But it's just something that's an element of planning that you can think. You can make your life a little bit simpler.
Got it. Interesting. Okay. There's still more. We are out of time.
Yeah,
Like you, that's barely scratching the surface of that because like Texas is kind of different compared to the rest of the country when it comes to community, right?
And it is, and every state has its own little quirky things. It's kind of interesting, and it's amazing. As many returns as I do, as many things that I always think, man, by now surely I've seen it all. And then you'll get a scenario where it's something so unique with how things are and what kind of income and the timing and the losses, and it's an amazing thing. It's always a puzzle. It's always an element when you have more complexity on the tax return, there's more elements of strategy for sure. If you have
Yeah.
more LLC, if you have more types of income, more passive and portfolio income like interest and dividends, it allows you to plan better because when you just have a W-2, there's really not a whole lot to plan other than when do you file this return. When
Hmm.
you have a mix of income that unlocks other strategies that could like really work together. And so that's kind of the message. Real estate allows you to venture a little bit outside of that W-2 income only and start exposing you to other things that's more conducive to planning and timing efficiencies and kind of playing your tax brackets more effectively. Because if you know you have a transaction coming up, you can time things, whether you're
Right.
moving from one job to the next, you can time your brackets, like what your income would look one year versus another. You can time your cost segregation studies. So that volatility of income up and down really allows you to plan better. And so I'm a big fan of kind of being as diverse as you can. And that's kind of what I've done personally. I've invested in different things just to give me a different opportunity to mix things and pull the right levers at the right time. But of course, the complexity goes up, the cost of your tax prep will go up as well. So you just need to kind of plan through all this, think through, and look at your personality and the time commitment that you can dedicate to running multiple streams of income and get yourself in front of the proper team, proper real estate partner and financing partner and the tax partner. Like all of those things could help you really navigate all of that and become successful. So that's just my message. Plan and execute. Find somebody who
yeah,
can help you execute if you're having a challenge with it.
In November, we are planning on coming back. Tax optimization, exit planning. You brought up cost segregation. We haven't even touched on that. And there's some interesting opportunities. Advanced depreciation. We do want to go back to 1031 exchanges, but it sounds like we have some pretty good alternatives to
mhm,
living that real estate lifestyle of the 1031 game that a lot of people are playing right now. So a lot of really
One
interesting.
element
Yeah.
before you sign off, one other element that works with self-directed IRA and real estate is you have to kind of be mindful of earned income because with IRA, again, if you go down the self-directed path, you do need to have earned income to be able to
Hmm.
fund more. So if you're short on funds, then you need to contribute more throughout the future year. So if you have only passive real estate income, you will not be eligible to contribute new funds into an IRA. So that's one of the things where you'll have to be
Uh,
mindful. If you have a working spouse, that'll unlock that opportunity. Or if you have other income like real estate flipping, that kind of income could allow you additional funding. So there's a lot of that to consider before you venture into a self-directed IRA. What is, and it's kind of easy to see what you've got because you'll know what the balance is in your account, but what the future hold and how cash flow will look is hard to know.
right.
And so that is like a big variable that's hard to predict. So a lot of planning needs to be done in self-directed, kind of future-minded versus the kind of retro. So
Yeah.
just like again, one big caveat on that.
Very fascinating. Andre, tell us again how we can get in touch with you, get connected with you.
Absolutely. My website is atlastax.net and my email is Andrey, Andrey at atlastax.net. I'm glad to connect, talk through some of the specifics, again, your interests, what you're looking to accomplish, and guide you accordingly.
I love it. Albert, any final words?
No, man, it's just I can't even tell you how many hours Andre and I have spent on Zoom calls just going through, especially when we first engaged together and him sifting through everything that we had done prior. Now, our calls are now more on the educational side, a little bit shorter. I mean, I've texted him so many times like, I'm overwhelmed, I'm not doing this anymore, but he's talked me off the ledge several times, but I would just encourage, our listeners and viewers to really reach out to knowledgeable people, find people like Andre who, not only know what they're doing, but they own real estate, they're
Hmm.
dealing in real estate, they're running businesses as well. So those are the people that I'm usually looking to add to my team is people that are in the business,
Right.
right? So, but find somebody to help you out with these things.
Absolutely. And there are plenty of people like that, like in my experience, a lot of people on the tax side, they're a little bit different. They kind of do that work specifically, but they see a lot of things. They see a lot of issues people create. That's why
Hmm.
some get kind of averse to certain more challenging opportunities. And that's why a lot of people stay away from self-directed because it is a unique thing. So you almost need to specialize and become a real big expert in it, or just like maybe don't even touch it at all because it could expose, you because things could change. And there's a lot of, so
Hmm.
that's why just, be realistic with where you want to go and who the right partners are. And there are plenty of them out there who specialize and you will find them with a little bit of help.
Mhm. Yep.
Perfect. Well, thank you so much for being on. We're going to get you back later this fall. And until then, don't forget, we are on Spotify, Apple Podcasts, YouTube. Like and subscribe, comment, share the love. If you want to be on live on the call, or if you want to invite somebody to be live on the call, feel free to send them our way. The call's at 12:30. Replays, these will go live at 5:30 a.m. on Tuesdays. So while you're getting that workout in the morning, you can start your day off with me and Albert. So we're
Awesome.
happy to keep you company. So until then, I'm Austin from Houston. This is my brother Alberto Medellin. Be blessed. Have a good week. Work hard, and don't and make sure you put in some time to learn and to master this content because it's going to give you a big advantage in the real estate investing world.
For
Peace out.
sure.
Bye.
Bye.
Bye, guys.